haven't seen you guys since last year. I'm Jordan Rodriguez of Wernick Wealth Managers here in Cleveland, Ohio. You know the drill by now. None of this is financial advice, recommendations, or solicitations. Feel free to check out our website. I'm going to put that as well as a link to some of my contact information and a bunch of links to things I'm going to reference throughout the course of this review in the show notes below. It's 2022, hoping you all had a great holiday season and a lovely new year. My wife and I capped off 2021 by getting COVID. Seems like everyone has it right about now. I was actually kind of intrigued to finally get it. One of those things that everybody's been talking about for years now. I had several people I know who also got it, but until now I could only read about other people's experiences. But anyway, let's get down to business. I'm kind of excited about this one because I decided to scrap a December review in lieu of a year-end review of 2021. It was a long year for a lot of reasons. I think you'll agree as I go through some of the economic and market and news highlights of the year that, I had several instances where I swore the event happened in 2020. I don't even know where to, well, we'll start with actually a story that I talked about early in the year in 2021. CEO departures, and I'm actually going to add in CEOs and other insiders selling company stock. In February, I highlighted the departures of Ken Frazier of Merck and Jeff Bezos of Amazon. We added Jack Dorsey to that list in the summer to round out over $2 trillion of market cap that will have new leadership. We can also now say that Doug Parker of American Airlines will be handing over the reins this year. But in addition to CEOs stepping down, there's been a flurry of insider selling in 2021. $70 billion to be more precise. The names we know like Mark Zuckerberg, Elon Musk, the Walton family, Satya Nadella, they've all sold significant stakes of company stock, 30% higher than the selling done in 2020, and get this, 79% higher than the 10-year average. Now, it's easy to speculate. Insider selling is a negative signal for the market, and there's some historical precedent that points to just that, insider selling signaling a relative top for those companies' stock. But if we look under the hood at what could be driving the selling, we'll see plenty of 10b5-1 planned selling or that's predetermined stock sales by corporate insiders like Mark Zuckerberg and the Google founders. If we look at examples like Jeff Bezos and Elon Musk, they have outside ventures beyond their main companies that take a huge amount of funding. And finally, if we consider Satya Nadella, for example, of Microsoft, could have saved himself $20 million in taxes just by selling the stock that he did sell in 2021 as opposed to waiting until 2022 before Washington State, home to Microsoft and Amazon, imposes a 7% state tax on capital gains. None of this even takes into consideration potential tax changes and surtaxes that could be introduced at the federal level in 2022. I attached a really interesting study below. It cites the heavy hitters from Malkiel to Siegel that explores the statistical significance of insider buying and selling. The overall messaging is that insider buying, not really selling, has signaled statistically significant outperformance in the stock over the short and intermediate periods of time. They did the study over a 1-month, 6-month, and year-long period. While insider selling was only relevant over those shorter time periods and became statistically insignificant by the 1-year mark. I encourage you to piece through that. It's a little dense, but you can work your way through that. All this put more simply by Peter Lynch. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. Now, here's a story that we talked about that's one of those that I couldn't believe was in 2021. Sometimes I think in memes, I probably shouldn't admit that, but I remember the picture of the little excavator trying to push the massive cargo ship, the Evergreen, from blocking the Suez Canal. It was kind of a funny story at the time, but throughout the year it became an example of the fragility of our global supply chains and the issues we've continued seeing. Another story I covered at the beginning of last year that I didn't know would evolve into such a cover story was the shortage of shipping containers and now the backlog of containers and carriers in global ports. Let's look at some cost and time comparisons from December of 2021 to December of 2020 from Freightos, a logistics software company. The cost of shipping a 40-foot container from Asia to the West Coast through the most expensive route was $16,536, a 236% increase from the previous year, December of 2020. Now, The cheapest route, Northern Europe to the east coast of the United States, was $7,248 for that same container. Still, even more of an increase, actually, a 281% increase. If we look through a different lens, the time it took for an LCL, less than container load, to ship from China to its end destination in the US was 76 days, up from 53 days at the end of 2020 and 43 days pre-pandemic at the end of 2019. So supply chain conversations, from labor shortages to input costs increasing, they're going absolutely nowhere in 2022. We'll revisit them constantly and analyze the health of the broader economy. 2021 was the year of the infrastructure bill and almost the year of the Build Back Better agenda. We saw the formulation and eventual passage of the $1 trillion infrastructure spending package that includes funding for everything from roads and bridges to broadband and our electrical grid. Here's the deal. We needed money allocated to infrastructure projects, and I think many people can agree on that basic fact, but I also think I speak for a lot of people who are skeptical of government spending. Allocating trillions of dollars towards projects handled by the bureaucracy of the federal government can lead to waste along the way, and coming on the back of trillions of dollars in COVID relief made something as seemingly benign as infrastructure spending a hotly debated topic. For context, because context is always key, knowledge is power, the federal government spent $6.82 trillion in 2021. That comes after more than $6 trillion in spending in 2020. The total spending in the normal years before the pandemic were in the $3 trillion range under Obama and the $4 trillion range under Trump. The resulting deficits skyrocketed from under $1 trillion in the pre-pandemic years to between $2.5 and $3.5 trillion per year in the past 2 years. Now the context is set, we have a few different ways to think about this, regardless of whether we think that this new spending and stimulus needed to be received over the past couple of years. The total outstanding debt of our country has ballooned from around $20 trillion in 2017 to almost $30 trillion as it stands right now. There are a number of different outcomes we can talk about. There's more money in the system. Liquidity in the form of federal spending, inflated unemployment support, and even checks deposited directly into people's bank accounts. This increase in demand for goods has been coupled with the supply constraints we discussed earlier, and the result is the highest CPI read we've seen since the early 80s, clocking in at almost 6.9% inflation. As a result of this inflation, the Fed has to throw some cold water on the economy. This takes a couple different forms, but the main mechanisms are tapering or reducing asset purchases of bonds in the open market and raising interest rates. We've talked about this ad nauseum, but let's go over it one more time. Raising interest rates creates less borrowing, and as a result, less spending and investment, a classic mechanism used to combat inflation. However, the Fed, and this is more my opinion than what will actually potentially play out in reality, but the Fed can only go so far when raising interest rates because the outstanding debt that we just talked about, that $30 trillion that our country has, requires interest payments to be made on it. If the Fed goes too far in raising rates, the interest expense that we owe on that debt as a proportion of federal spending, it'll just become too much to bear. Now, how else can the problem of deficits and huge outstanding debts be solved? If you're an individual who has a huge amount of credit card debt, the first action you hopefully take is to stop spending. This loops back to the original conversation of why an infrastructure spending bill became so controversial. There's just less of an appetite, rightfully so, for that spending. Also the reason why the Build Back Better initiative was tabled. Back to the example of an individual with a lot of debt, the next idea could be to reallocate funds to pay down the balance, similar to the first idea of reducing spending. The reduction of current expenses may also be needed. Conversations such as Social Security and Medicare reform, reduced defense spending, etc., will inevitably continue to arise as we deal with this issue. And finally, it may behoove this person to make more money. Might be an awkward conversation, but our individual can march down to his or her boss's office and say, "Give me a raise, I need it, I deserve it." Well, what we're describing now is an increase in tax revenue collected by the federal government to pay down these debts. We've seen corporate tax increases, minimum global corporate tax rates, and the discussion of increased tax rates for individuals and estates. All of these conversations we've had throughout the past year are directly tied back to the increased deficit and debt of the federal government, and the answer will likely be a combination of all of the options on the table. We'll continue monitoring in 2022, 2023, every year for the rest of our lives. But let's change gears, talk about some more fun stuff. We started the year, I think it was my first podcast actually, talking about meme stocks and cryptocurrencies. So if we get a price check on aisle 3, GameStop, the original meme stock, ended 2021 up almost 700%. AMC, a close second that actually became that top meme name toward the end of the year, up almost 1,200% in 2021. Bitcoin logged around a 60% gain, and Ethereum returned over 400%. Broadly speaking, if you were invested in diversified equities, you were a happy camper. All of the major indices were decidedly positive, with energy of all sectors leading the way in 2021. Thanks to a rise in oil prices, the broad energy sector returned almost 50%. Where there are winners, there are also losers, and Cathie Wood's ARK Innovation ETF got absolutely dragged. While it doesn't invest in any particular sector, the ARK ETF serves as a proxy for disruptive, growth-oriented companies that are largely not profitable, and even the ones that have super stretch valuations. So the ETF was down almost 25% on the year, and to make things even harder to swallow, some investors who entered at the initial growth bubble popping in February are 40% off of their highs. So comparing energy to ARK, it's not a fair comparison, but let's just do this. Over the course of 2021, the year-end spread between the two is like 75%. I'm not here to bash Cathie Wood, say that 5 times fast, and her team, or to tout energy as the hot topic of 2022. I simply want to show you how different your returns could have been this past year, depending on how you were invested. Humor me though. Let's dial the clock back to the beginning of 2020. I know this is a 2021 podcast, but we're just going to look at the overarching concept here. So if we go back to before the pandemic started, using these same 2 examples, energy and the ARKK ETF, your return as an energy investor over this 2-year period is a big fat nothing burger. In fact, you would have had to have had the fortitude to endure a negative 30% year for energy in 2020, and hung on all the way until the end of 2021 just to break even. Now, consequently, an investor in ARK who bought at the beginning of 2020 and held through the end of this past year doubled their money. So if we go back 5 years now, the energy investor would have lost about 12% by being invested the entire time, while ARK investors would have 5x their money over that same time period. So this time I've got to say I'm not praising Cathie Wood as the best investor of all time or foo-fooing energy's ability to generate returns. Might be a pun in there. What I'm illustrating is the importance of diversification over a long period of time and avoiding irrational decision making in the short term. Being a long-term investor is measured in multi-year periods, even decades. Short-term underperformance is the price of admission. Make sure you have the time horizon and the risk tolerance to participate. What I want to do now is rapid fire a bunch of short highlights that we covered over the course of the year. I may actually include a couple that we didn't discuss explicitly. Intellia Therapeutics reported positive trials for a liver therapeutic, represented the first clinical evidence that CRISPR gene editing administered in vivo or inside the body can work. The COP conference in Glasgow led to a number of environmental announcements, one of the most hopeful being net zero emissions targets adopted by 90% of the global economy. SpaceX, Elon Musk's other company, now has almost 2,000 Starlink satellites in Earth's orbit. Musk's company aims to provide internet access to those who live in areas where traditional fiber optic internet connection is not possible. Global, universal internet access is the goal here. Staying with the space theme, we had several billionaires make news with space exploration, but a story that flew largely under the radar, another bad pun, I didn't even try that one, I promise, was NASA's conversion of carbon dioxide into oxygen on Mars with their rover Perseverance. And in a rare pivot from COVID, China officially became malaria-free in 2021. It wasn't all good news around the world, though. Plenty of tumultuous geopolitical concerns remain. A botched departure of U.S. troops from Afghanistan led to the deaths of American troops and innocent civilians. Taliban control of the country has led to increased restrictions on personal freedoms, especially for women, as media outposts shut their doors and election monitoring bodies were disbanded. China continues to be accused of oppression and genocide against Muslim minority populations in their country. This comes alongside increased surveillance and government control of private industry. The question of what will happen with Taiwan lingers and may come to a head in 2022. For a number of reasons, I think that may actually not be the case. Always happy to discuss, but for the sake of time, we're not going to dive into that right now. We didn't talk about Iran much in 2021, but 2022 is the year some estimate Iran will be able to produce enough enriched uranium to develop a nuclear weapon. Coupled with deteriorating discussions with the U.S. regarding a nuclear deal, conflict between Iran, Israel, and the United States and other Middle East countries becomes more likely. I want to end with some stuff that I'm going to be watching in 2022, and I think we should all be watching a lot of stuff, but I'm going to list a few. Fed interest rate increases. How high do they go? We talked about this a little bit earlier, but how does the rest of the yield curve respond? Remember, the Fed only controls the very short end of the curve, the Fed funds rate. And what is the growth sell-off that we've been experiencing as the taper conversation and the interest rate increase conversation has progressed? Is that growth sell-off, is that overdone in the short term, or is this just the beginning? Biotechnology. Incredible developments have been made over the past couple of years as it relates to gene therapies. The pandemic has shifted a lot of focus toward mRNA vaccines, but the wide-ranging application of these technologies has not gotten even close to their potential. Terms like metaverse, Web3, and blockchain, mainly, I'm looking for those to go away. I'm incredibly excited and hugely optimistic about the future of technology and the advances we're on the cusp of. But the wheat needs to be separated from the chaff, and there's a lot of garbage floating around out there alongside the legit companies and applications. My first interview of this 2022 year is going to focus on long-term tech trends with an analyst from BlackRock. I haven't recorded it yet, but I expect it to be really exciting, kind of a sexy way to start the year, actually. And speaking of the new year, I hope everyone makes the conscious effort, the conscious decision to make it a really good one. Schedule your day out, create time for yourself to do things that you want to do. Find some time to think or pray or meditate. Shake the thought process that we've fallen into that news, I'm going to put that in air quotes, is something that needs to be constantly consumed, that it's the responsible thing for us to be doing, and instead diversify and limit your media diet. There's plenty going on right in front of you. I look forward to another year with you all. Take care, and again, tune into this upcoming interview. It's going to be a good one.